The markets have endured great bubble trouble, so joining us now is Dr. David Blitzer. What are some of the key strategies that people can use to maybe identify bubble potential out there?
Bubbles have clearly become a big topic of conversation in the last few years, and we've suffered through at least two notable ones. Technology, if you go back about 10 years, and then housing over the last few years. In fact, housing is slowing down, but probably not completely over. In terms of looking for bubbles, it's really very difficult. I don't think anybody is absolutely sure they're in a bubble until it's too late and it's already burst. But if one looks at some fundamental measures of the stock market or for housing also, such as the ratio between the cost of buying a house and the cost of renting a house, one can get some sense as to whether the markets are far out of line or just about where they should be. Having a strong idea of is it going to pop tomorrow or is it going to keep climbing for a while is unfortunately a lot more difficult.
I'm wondering as well how bubbles begin to form, because right now I'm not so clear on what bubbles could be forming out there. I have some guesses. One might even be alternative energy and just in the environmental plays. What do you see, or what are you really watching for?
What you need is something that sort of pushes the whole economic system off where it usually is in one direction or another. Sometimes called displacement. Very low interest rates in the middle of the last decade, say 2003, 2004, were clearly the displacement for housing. Housing, from the point of view of buying and then paying the mortgage, became incredibly cheap. You then get the ball rolling a little bit. People get excited. They start telling stories. It's a great time to buy a house. The value of your house will never go down. The price of your house will never go down. And it feeds on itself. You get positive feedback.
It sounds like greed as well plays into this.
Oh, there's a whole lot of greed in it. There's no question about it. It's really human psychology. But anybody who thought that markets trade and act only on fundamental facts and no human psychology obviously never traded anything.
When you go into trading and people are watching for this financial bubbles, how do you trade, or what's the trading strategy when financial bubbles form?
Well, the first is a sort of a fascinating schism. If you talk to journalists or regulators and politicians, their assumption is the moment you think there's a bubble, rush out there and pop it, make it go away, get rid of it. If you talk to somebody who's trading, the moment he thinks there's a bubble, he's got a whole different idea. It's let's hop on board and ride it for all it's worth, and so on. So the first thing is to know who you are and adapt the appropriate direction or approach or angle or something like that, and so on. And now it's really a question of balancing the risks, because as it keeps going up, the chances that it's going to pop right away certainly don't go down. They may not get bigger, but they don't get smaller. And what you really got to do is look at this as a decision problem. You can sell, you can hold on, or I guess you could buy even more, but maybe that's really risky, nerving or risky or something like that. But I think you constantly look at the fundamentals, you look at how far it's gone, how long it's been going on, and try and reevaluate the strategy. And you really can do it as a statistical decision problem. You've got to decide, is it about to pop or not? And that's your bet. On the other hand, the real decision is going to be made by the market. So if the market is about to pop, look at the gains and the losses. If the market's going to hang together for another month, look at the gains and losses, and then take the appropriate bet to minimize the danger of really getting wiped out.
Earlier you talked about the housing bubble and how you think it's still not over. How close are we, or what stage are we in right now as related to the housing market?
Well, first thing to recognize is housing compared to financial markets like options or futures or stocks, housing moves at a glacial pace. And the financial markets move at a very fast, frenetic pace. So housing, you get the data once a month in the housing work we do, so that gives you a sense of the pace. Prices have clearly peaked and are headed down. In round numbers, they peaked in about 2006, 2007, and they're back to where they were in 2003. But looking at those fundamental numbers again, for a lot of markets, especially in the Sun Belt in the United States, 2003 was pretty high, rich levels anyhow. So in some areas, they're probably not back down to where they were. Some of the older cities in the upper Midwest and the Northeast, including Chicago, they never went sky high, so that they've come down and they may be pretty close to some kind of a balance. And in one city in particular, Detroit, Michigan, unfortunately, they're way below where they were 10 years ago
Yes, they are.
because of the auto industry.
Okay, we've been speaking with Dr. David Blitzer.